Most people have no idea how multifamily developers actually get paid. It's just not something that gets talked about openly very often. You see people like me talk about their projects online, or maybe you drove by apartments being built, but the compensation method for developers still seems pretty vague. So today I'm pulling back the curtain on that because it's actually pretty interesting, and because I think more transparency around how this business works is actually a good thing. On the flip side, if you're wondering how investors actually make money by investing in a multifamily development, I did a video right here that breaks all that down. So let's get right into it. There are three primary ways developers get compensated on a multifamily development deal. Let's start with the development fee. The development fee is basically compensation for everything it takes to get a building out of the ground. And I mean absolutely everything. Everything from finding the land, getting it under contract, working through entitlements, managing the design team, securing construction financing, and communicating with investors, just to name a few. It could take months or even years to even start a development project, and even then, you still have years of work before a single unit ever gets leased. So developers charge a fee for that work to compensate them for their time, effort, expertise, and the risk they're taking on. The development fee is typically calculated as a percentage of total project cost, and it gets built right into the capital stack from the very beginning. Now, while the development fee can be a decent payday for the developer, this isn't even how the developer makes the majority of their money. I talk about that towards the end of this video. Most development fees are 5% of the total project cost, but they could be more or less depending on the deal. So on a $10 million project, a 5% development fee would be $500,000. And we do something pretty interesting on our projects. Instead of taking the full fee up front, we get paid based on certain milestones throughout the life of the project. So for the way I do it, I break my development fee into thirds. So I collect 1/3 at closing when construction starts, and then leave the remaining 2/3 of the fee into the project as additional contingency funds. So if something major happens and we burn through our regular contingency, we would then still have the allocated development fee to spend on that. So by leaving in the majority of our fee in the deal, we basically have an extra layer of contingency. If everything goes according to plan, I will collect another third at construction completion and the remaining portion at stabilization, which is when the property hits its target occupancy. Now let's talk about cash flow, because this is where the reality of development is a little different from what most people expect. Once the property is built and tenants are in place, the building starts generating rental income. After you pay off operating expenses and debt service, whatever's left is free cash flow. So yes, the developer can earn their share of the cash flow. However, since many ground-up projects are structured as syndications, developers are not earning significant cash flow during the whole period. And the reason for that is the preferred return. So at least in the projects we're doing, our passive investors receive a preferred return, which is usually somewhere between 6 to 8%. So before the developer can take a penny of profits from the deal, investors must first earn their preferred return. So most often, when cash flow is available, it goes to investors before it reaches the developer. On a typical ground-up project, especially in the early years of a lease-up when rents are still ramping up and reserves are being built, cash flow to the developer is usually non-existent. And that's just the reality of the business. So if the development fee gets spread across a multi-year period and cash flow during the whole period is usually low, where does the real money come from? Here's where it gets interesting. The third way developers make money is by the promote. The promote is the developer's share of profits when the asset eventually sells. Sometimes you'll hear this being called carried interest. This is the general partner's upside in the waterfall structure, and it's the primary reason why ground-up development can be a very lucrative business if you execute it well. Here's how the basic mechanics work. When the property sells, the investor's original principal and any outstanding preferred return is paid back. Then whatever profit is left gets split between the investor and the developer according to the waterfall laid out in the operating agreement. That profit split is where the promote lives. A common structure might look something like 70-30, where 70% goes to the investors and 30% goes to the developer. That 30% can be very significant, and this is where the developers make the bulk of their profit. And that's what makes the years of work, the risk, the sleepless nights during construction, the change order negotiations, all of it worth it. But it's back-end loaded, meaning the developer gets their fair share of the profits only after the business plan has been executed and their investors make money. The developer wins after their investors win. The alignment is real, and that matters. So to bring it all together, developers make money in three ways. the development fee, which compensates for the work of building the project, cash flow during the hold period, which is real but often modest in the early years, and the promote, which is the back-end profit share when the asset sells, and the primary reason the business model makes sense. Understanding how developers actually get paid gives you a clearer picture of what this business actually looks like. So what surprised you the most in this video? Drop it in the comments below, I read all of them. And if you want more content like this, subscribe to my channel, and I'll see you on the next one.